Welcome to Thoughts on the Market. I'm Jim Egan, co-head of Securitized Products Research at Morgan Stanley.
And I'm Jay Bacow, the other co-head of Securitized Products Research at Morgan Stanley. And after getting through last week's blistering hot temperatures, today we're going to talk about what may be a cooling housing market. It's Monday, June 30th at 2:30 p.m. in New York. Now, Jim, home prices, we just got another index. They set another record high, but the pace of growth, the acceleration, as the physicist in me wants to say, appears to be slowing. What's going on here?
The pace of home price growth reported this month was 2.7%. That is the lowest that it's been since August of 2023. And in our view, the reason is pretty simple. Supply is increasing while demand has stalled.
But, Jim, this was a report for the spring selling season. I know we got it in June, but this is supposed to be the busiest time of the year. People are happy to go around. They're looking at moving over the summer when the kids aren't in school. We should be expecting the supply to increase. Are you saying that it's happening more than it's anticipated?
That is what we're saying. Now, we should be expecting inventories today to be higher than they were in, call it, January or February. That's exactly the seasonality that you're referring to, but it's the year-over-year growth we're paying attention to here. Homes listed for sale are up year over year, 18 months in a row. And that pace, it's been accelerating. Over the past 40 years, the pace of growth from this past month was only eclipsed one time, the Great Financial Crisis.
I always get a little worried when the housing analyst brings up the Great Financial Crisis. Are you saying that this time the demand isn't responding?
That is what we're saying. So through the first 5 months of this year, existing home sales are only down about 2% versus the first 5 months of 2024. So they've basically kind of plateaued at these levels. But that also means that we're seeing the fewest number of transactions through May in a calendar year since 2009. And that combination of easing inventory and lackluster demand, it's pushed months of supply back to levels that we haven't seen since the beginning of this pandemic, called the fourth quarter of 2019, first quarter of 2020, right before inventories really plummeted to historic lows.
All right, so 2009, another financial crisis reference, but you're speaking around a national level. And as a housing analyst, I feel like you haven't really spoken about the three most important factors when we think about things, which are location, location, and location.
Absolutely. And the deceleration that we're seeing in home price growth, and I would point out, it is still growth, has been pervasive across the country. Year over year, HPA is now decelerating in 100% of the top 100 MSAs for which we have data. In fact, a full quarter of them, 25% of these cities, are now actually seeing prices decline on a year-over-year basis, and that's up from just 5% with declining home prices 1 year ago.
As a homeowner, I do like the home price growth. And is it the same story when you look more narrowly around supply and demand?
So there might be some geographical nuances, but we do think that it largely boils down to that. Local inventory growth has been a very good indicator of weaker home price performance, particularly the level of for-sale inventory today versus that fourth quarter of 2019. If we look at it on a geographic basis, of the 14 MSAs that have the highest level of inventory today compared to 2019, 11 of them are in either Florida or Texas. On the other end of the spectrum, the cities where inventory remains furthest away from where it was 4.5 years ago, they're in the Northeast, they're in the Midwest.
As somebody who lives in the Northeast, I'd like to hear that again. But you're quoting existing prices, which that's been the outperformer in the housing market, right?
Exactly. New home prices have actually been decreasing year over year for the past year and a half at this point. It's actually brought the basis between new home prices, which tend to trade at a little bit of a premium to existing sales. It's brought that basis to its tightest level that we've seen in at least 30 years. And that's before we take into account the fact that home builders have been buying down some of these mortgage rates. But Jay, you've recently done some work trying to size this.
Yeah. First, it might help to explain what a buy-down is. A home builder might have a new home listed at, say, $450,000. And with mortgage rates in the context of about 6.5% right now, the home buyer might not be able to afford that. So they'll offer to pay less. The home builder, often many of them also have an origination arm as well. They'll say, you know what, we'll sell it to you at that $450,000, but we'll give you a lower mortgage rate. Instead of 6.5%, we'll sell it to you for $450,000 with a 5% mortgage rate. Then maybe the home buyer can afford that.
And so new home prices are actually coming down, and by that we're specifically referring to the median price of new home transactions. They're falling despite the fact that these buy-downs might be influencing prices a little bit higher.
Right. And when we look at how often this is happening, it's a little actually hard to get it from the data because they don't have to report it. But when we look at the distribution of mortgage rates in a given month, prior to 2022, there were effectively no purchase loans that were originated less than 1 point below the prevailing mortgage rate for a given month. However, more recently, we're up to about 12% of Ginnie Mae purchases, and those are the more credit-constrained borrowers that might have a harder time buying a home, and about 5% of conventional purchase loans are getting originated with a rate 1% below the outstanding market.
And so this might be another sign that we're seeing a little bit of softening in home prices, but what are the implications on the agency mortgage side?
I would say there's probably two things that we're keeping an eye out on. Because these are homeowners that are getting below market rate, the investors are getting a below market coupon, and because they're getting sold at a discount, they don't want that, but they're going to stay around for a while. So investors are getting these rates that they don't want for longer. And then the other thing you think about from the home buyer perspective is, maybe it's good for them right now, but if they want to sell that home, because they're getting a below market mortgage rate, they bought the home for maybe more than other people would have. So unless they can sell it with that mortgage attached, which is very difficult to do, they probably have to sell it for a lower price than when they bought it. Now, Jim, what does all this mean for home prices going forward?
Now, when we think about home prices, we're talking about the home price indices, right? And so those are going to be repeat sales. It's going to, by definition, look at existing prices and not necessarily the dynamics we're talking in the new home price market.
Okay, so all this builder buy down stuff is interesting for what it means for new home prices, but doesn't impact all of the HPA indices that you reference.
Exactly. And at the national level, despite what we've been talking about on this podcast, we do think that home prices remain more supported than what we are seeing locally. Inventory is increasing, but it also remains near historically low levels. Months of supply that I mentioned at the top of this podcast, it's picked up to the highest level it's been since the beginning of this pandemic. We're also talking about 4 to 4.5 months of supply. Anything below 6 is a tight environment that has been historically associated with home prices continuing to climb. That's why our base case is for positive HPA this year. We're at plus 2%. That's slower than where we are now. We think you're going to continue to see deceleration. And because of what we're seeing from a supply and demand perspective, we are a little bit more skewed to the downside in our bear case. Instead of that plus 2, we're at minus 3%, than we are towards the upside in our bull case. Instead of that plus 2, we're at plus 5% in the bull case. So slower HPA from here, but still positive.
Well, Jim, it's always a pleasure talking to you, particularly when you're highlighting that the home price growth is going to be stronger in the places where I own a home.
Pleasure talking to you too, Jay. And to all of you listening, thank you for listening to another episode of Thoughts on the Market. Please leave a review or a like wherever you get this podcast and share Thoughts on the Market with a friend or colleague today.
Go smash that subscribe button.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.